The stock market is currently riding a wave of optimism, with the Nasdaq and semiconductor stocks hitting historic winning streaks. But the strategists at BCA Research are warning that this aggressive climb mirrors the late 1990s dot-com era with striking accuracy. This chart shows the path of a melt-up, a sharp, euphoric final rally. If this pattern holds, the U.S. market could climb another 30%, potentially taking the S&P 500 past the 9,200 mark. These analysts aren't just guessing about a potential crash. They are monitoring 4 specific data points, suggesting that the AI boom is reaching a mature and potentially dangerous late-stage phase. Mistaking this final surge for sustainable growth is the primary risk for investors, as these 4 indicators suggest the cycle is nearing its peak. To understand the risk, we have to look at the diagnostic. Unlike past bubbles that relied on speculation, this initial surge is tied to actual corporate adoption. This map shows where that demand is coming from. The Ramp AI Index, which measures businesses paying for AI subscriptions, recently topped 50% for the first time. This surge in software usage creates a persistent, long-term pressure on the physical infrastructure required to host these tools. We see this pressure in the hardware market. Rental rates for NVIDIA B200 cloud GPUs rose 13% in a single month. While cooling slightly from peaks, GPU and memory costs remain near record highs, reflecting a supply struggling to keep pace with corporate ambition. While this demand proves the technology is useful, this level of hardware scarcity is what often triggers the next phase of a market cycle: panic-driven capital spending. This brings us to the third indicator, an explosion in capital expenditures. Tech giants are spending at a scale rarely seen in corporate history to secure their lead in the AI race. This chart shows projected spending for Amazon, Google, Meta, and Microsoft. Together, they are estimated to spend $587 billion on CapEx this year. Comparing these 2026 estimates against the 2023 baseline, the acceleration is nearly vertical. However, as this spending soars, the financial health of the sector is showing its first signs of strain. While financing inflows look strong, a significant portion of that capital is being used for share buybacks and dividends. This suggests that some of the financial activity we're seeing is driven by capital allocation strategies rather than just operational growth. The fourth indicator is found in the credit markets. This chart tracks credit spreads, the difference in interest rates between tech debt and the broader market. A widening spread means bond investors demand a higher premium, signaling they see more risk in tech companies today. When the credit markets begin to price in higher risks for even the largest tech giants, it suggests the financial foundation of the boom is facing its first major stress test. This leads to an important question. How can the market face a crash if the technology itself is actually succeeding? The answer lies in a philosophical shift. The risk isn't that AI will be a technological failure or a dud. Rather, the risk is that we may build an AI-empowered economy that simply doesn't require the trillions of dollars in data center infrastructure currently being built. In the short term, a 1999-style melt-up remains likely, fueled by momentum that could push indexes another 30% higher. To navigate the coming years, investors will need to distinguish between the undeniable utility of the technology and the increasingly expensive financial math used to value it on Wall Street,